Why Americans are drowning in debt. Many Americans are finding it difficult to manage multiple financial obligations and keep up with essential expenses as they grapple with an increasing debt crisis. Loan delinquencies and consumer debt have increased as a result of several factors coming together. In this video, we will explore some of the significant factors in detail, shedding light on the intricate problems that American households face. Number 7. Inflation and rising costs of essential expenses. Due to its substantial impact on American households' purchasing power, inflation has emerged as a major concern. Inflation rates have skyrocketed in recent years, hitting levels not seen in decades. Prices for necessities like food, housing, transportation, and healthcare have increased as a result of this increase. For example, the price of groceries has increased significantly, with noticeable price increases for staples like bread, milk, and eggs. The cost of housing has also gone up, whether it is due to higher mortgage interest rates or higher rent, which makes homeownership less accessible for many. A greater percentage of income must now be set aside by many families to pay for these necessities, since wages have not increased in line with inflation. People who are under financial strain frequently turn to credit cards or personal loans to make ends meet, which raises their debt levels. Families with low and middle incomes are especially badly affected because they spend a larger portion of their income on necessities, leaving little money left over for savings or discretionary spending. As a result, depending too heavily on credit to maintain a minimal standard of living can lead to an unmanageable debt cycle, particularly in the event of unforeseen expenses. Number 6. Reduction in work and income. A number of factors, including globalization, economic fluctuations, and technological advancements, have had a significant impact on the labor market. Particularly during economic downturns or crises like the COVID-19 pandemic, which led to widespread layoffs and furloughs, many workers have experienced job loss or reduced hours. Many people continue to face job insecurity, underemployment, or stagnant wages that do not keep up with inflation even as the economy improves. Any decrease in income can make it difficult for people who live paycheck to paycheck to pay their debts, including rent, mortgage payments, and loan repayments. Due to their unstable financial status, many are forced to use credit cards to pay for necessities, which can result in debt accumulation. Financial instability can have a significant emotional toll as well, increasing stress, anxiety, and even depression. People who are struggling to make ends meet due to uncertainty about their financial futures may make bad financial decisions, like taking out high-interest loans or using credit cards for regular purchases, which will only make their problems worse. Number 5. Forgetting to pay bills. Keeping track of personal finances in a world that is becoming more digitally driven and fast-paced can be daunting. Many people juggle work, family, and social obligations in addition to their other responsibilities, which can cause them to forget to pay their bills. According to surveys, a sizable portion of customers acknowledge that they have missed payments because of simple mistakes. This problem may be made worse by the intricacy of contemporary financial products, which frequently involve multiple accounts with various payment schedules. People might have several credit cards, utility bills, and loan payments, all of which have different due dates. Although payment apps and digital banking provide tools for managing finances, the sheer amount of data available can also cause errors and confusion. Furthermore, failing to make payments on time can lead to late fines, higher interest rates, and harm to credit ratings, all of which can compound the problem of financial strain. Having to deal with numerous debts can have a psychological toll and raise anxiety, which makes it harder for people to maintain organization and proactivity in their money management. Number 4. Difficulty managing multiple debts. Managing numerous financial responsibilities can get more difficult and stressful as consumers accrue debt, especially from credit cards and loans. Many people find themselves managing multiple accounts, each with varying interest rates, due dates, and payment amounts. Due to this intricacy, errors and confusion may occur, including missing or incorrectly paid payments. A considerable portion of consumers state that they feel overburdened by their debt, which can exacerbate anxiety and leave them feeling powerless. Some people may engage in avoidance behaviors as a result of this intense emotion, ignoring their debts rather than facing them, and thus worsening their financial situation. People frequently turn to taking on new debt in order to pay off their current debt, which exacerbates their financial circumstances. Options for consolidating debt, like balance transfer credit cards or personal loans, can ease the burden by streamlining payments and possibly bringing down interest rates. But a lot of people don't know about these options, or they might be too afraid to ask for assistance, which keeps them stuck in a debt cycle. In order to break this cycle, people must have access to resources that can help them manage their debts responsibly and receive financial education. Number 3. Insufficient income to cover spending. An increasing proportion of Americans discover that their earnings are insufficient to cover their essential living expenses. Many workers now find it difficult to meet their financial obligations as a result of stagnating wages and growing living expenses. A considerable fraction of the population, according to numerous studies, live paycheck to paycheck, which means that any unforeseen expense like a medical bill or auto repair can put them in financial hardship. People who don't have a safety net for their finances are frequently forced to use credit to make ends meet, which results in debt accumulation. Financial insecurity can have a significant psychological impact as well, causing stress, anxiety, and even depression. People who are struggling to make ends meet and have mounting debt may make bad financial decisions, like taking out high-interest loans or using credit cards for regular purchases, which will only make their problems worse. Furthermore, the fear of missing payments can result in a vicious cycle of borrowing from which people are unable to break free. Instead of saving money or making investments in their future, they may find themselves stuck in a never-ending cycle of debt repayment. Number 2. Reliance on credit cards and buy now, pay later loans. Credit cards and buy now, pay later services are becoming more widely available, which has made it simpler for customers to make purchases that require deferred payment. Even though these financial instruments can offer temporary respite, they frequently result in the accumulation of long-term debt. The entire cost of borrowing, including interest rates and other fees, which can mount up quickly and become burdensome, is something that many consumers underestimate. Because BNPL options are convenient, people may feel less immediate financial pressure to make purchases, which could lead to impulsive spending. Nevertheless, many find themselves unable to make the entire payment by the deadline, which results in more debt and interest. Due to their reliance on credit, people may find themselves in a vicious cycle of borrowing where they make the minimum payments but accumulate more debt, making it difficult to break free from. Moreover, vulnerable populations are frequently the target of credit card companies and BNPL providers' marketing strategies, which exacerbates already existing financial difficulties. When credit is used for routine purchases, it can create a debt culture in which borrowing is used more as a way to manage one's financial needs than as a way to accumulate wealth. Number 1. Lack of emergency savings. A large segment of Americans is susceptible to financial shocks because they do not have sufficient emergency savings. People who don't have a safety net for money frequently have to rely on credit to pay for unforeseen costs like car repairs, medical emergencies, and job loss. This reliance on credit can quickly spiral into debt, particularly for people who are already having trouble making ends meet. Lack of savings makes it more difficult to recover from financial setbacks and raises the risk of getting into debt. High living expenses or low wages can deter many people from saving, creating a never-ending cycle of financial instability. Even a modest emergency fund can help people avoid relying too heavily on credit by acting as a buffer against unforeseen costs. Reaching this objective, though, could be difficult for people who are already struggling financially. Financial literacy initiatives that stress the value of saving money and offer doable methods for amassing an emergency fund are crucial to assisting people in achieving financial stability. Furthermore, systemic improvements like easier access to affordable, high-quality financial products can help people save more money and become less dependent on credit. In conclusion, the combination of these elements presents a difficult financial environment for a large number of Americans, resulting in mounting debt and unstable finances. In order to support consumers in effectively managing their finances, addressing these issues calls for a multifaceted approach that includes enhanced financial education, improved resource accessibility, and systemic changes. If you like our video, please hit the like button and subscribe to our YouTube channel.